All right, topic one, introduction. As I mentioned in the introduction video, the exam consists of conceptual and problem solving questions. And the stuff that we're going to talk about in this topic is mainly conceptual, but it's really important. You can't really do the math well without understanding the concepts. So you want to pay attention. Okay. So we're doing finance in this course. So finance has many definitions, but according to one textbook, finance is the management, creation, and study of money and investments. Okay. So basically, we're just gonna talk about money, how people and corporations make money, and things like that. Okay. So, broadly, finance can be categorized into two broad areas. One is corporate finance, and the other is asset pricing. So, a lot of the topics that we're going to cover in this course deals with corporate finance. Let's see if I can use this. Yeah, corporate finance. Okay. So, at some schools, this course is called corporate financial management or intro to corporate finance. So we'll be talking about how corporations use money to make money. Okay, so we'll talk about that today. And the second part, or the second broad area in finance, is called asset pricing. So we're going to talk about this too, but what it is pretty simple. So as the name suggests, there's an area in finance where people try to price assets. Okay, so assets can be anything. For example, you can't see me right now, but I'm holding an Apple pen. Okay, Apple pen is a product. It's an asset, right? And it gives me some value. It's valuable to me because I get to use this during my lectures, write on my iPad. Uh, that's all I do with it, but it's valuable. Okay. And the question in asset pricing is, okay, it's valuable. How much? Uh, or how much is it valuable? Is the question. Okay. So we're trying to come up with the price of this pen that provides value to these consumers. Okay, so it can be anything: Apple Pen, a tumbler, uh, whatever, bicycle, whatever. Okay, but in this course, we're gonna try to value. Uh, so this would be like physical goods, right? But we're not gonna value physical goods. We're gonna try to value financial securities. Financial securities. So these are basically deals by some entities. Could be governments, could be corporations. So we're gonna try to value securities like government bonds or corporate bonds or corporate stocks. Okay, so these are financial securities, and we're going to try to come up with the price of these securities. Okay, and that's asset pricing. Okay, so we're going to talk about both of these, and later in the final chapter, we're going to talk about investments, portfolio management, and things like that. Okay, so hopefully you'll find this course useful so that you understand the basics of finance, and hopefully it'll help you make good investment decisions and investment and financial decisions in the future. Okay? Okay. Actually, before this slide, let me explain something else real quick. Okay? So I'm going to talk about a fundamental assumption in finance. Okay? Just call this fundamental assumption. Is that right? Assumption in finance and economics. Okay, just do /economics. So it has to do with people's attitude towards risk. So attitude toward risk. And we're going to define risk as any volatility in outcome or uncertainty in outcome. Okay, so any volatility or uncertainty we'll call risk, and we're going to talk about right now how people feel about risk, what the assumption is in finance and economics. Okay. So if we were doing this in person, I usually do this in the first day of class when I take attendance. I tell you about this game. Okay, so think about this game. We'll say this game is, we're gonna flip a coin. Okay, we're gonna flip a fair coin. Okay, we're gonna flip a coin. So the outcome is either you get heads or tails, right? We'll just say if the coin lands heads, you'll get a payment of $0. Okay, and if it's tails, you'll get $100. Okay, that's the game. Okay, so what I do in class usually is I go around and ask people when I take attendance to tell me their number, and the question is, how much are you willing to pay to play this game? So this is sort of like an asset pricing question. Okay, we have this deal or this little game. It gives you some kind of a payment, and it has some kind of an uncertainty. Okay, and the question is, how much are you willing to pay to play this game? Okay, so try to come up with a number. There is no right number. It depends on your preference. Okay, so no right number. It depends on your preference. Okay, depends on your risk appetite is what we call it. I don't know how to spell. Is that right? Appetite, maybe. Risk appetite. Okay. So yeah, come up with a number. I'll give you like 5 seconds. So, so during these regular semesters, usually the class average is between like $20 and $30. Okay, so that's the class average. The number usually ranges from, like, some people say 0, I'm not gonna pay anything to play, to some people who I don't know, maybe misunderstood the game, say $100 sometimes. Okay, so that's the range usually, and the average becomes $20 to $30. Okay, and this is very interesting because if you go back to your statistics course, you know how to calculate the expected values of these things, right? So we're flipping a fair coin, right? So the probability that the outcome is heads is 50%, and the probability that it's tails is also 50%. And these are the realized values when it's heads and tails. Okay. So if you were to calculate the expected value of this game, I'll just do it here. Expected value of the game, it's just 50% times 0, the probability that it lands heads, and the outcome that you get if it is heads, plus 50% times $100. That is the probability that the outcome is tails, and the payment that you get when it is tails. Okay, so the expected value of the game is $50. Okay, statistically, right? You see that we couldn't do it here, but the class average is usually less than $50. That's the key observation here. Okay, so even though the fair value from a statistical point of view is $50, this game, people are willing to pay less than $50 to play this game. They're applying a discount. Okay, people want to pay less. Okay, there's a discount. Okay. Why is that is the next logical question, and it deals with this first thing that we talked about, risk, the volatility in outcome. Okay, uncertainty. Here the game is pretty straightforward, but the outcome is volatile. Okay, it's uncertain. You don't know what's going to happen, right? So because of the risk, people discount the value of this game. Okay, so that's the key assumption in finance. Rational investors are risk averse. This is the key. Rational investors are risk averse. They don't like risk. They don't like risk. Okay, they don't like risk. Okay, so this is the risk aversion. That's the key assumption in finance. Okay, and I'm going to illustrate this one more time using a different example. Okay, right here. So again, we're talking about risk aversion. So here, I'll give you two choices. Okay, let's say, assume that you have two choices. Choice one is someone will give you $1 million just for sure. Okay, you get, if you just pick choice one, you get $1 million. Good deal, right? Oops. And second choice is now similar to the first example that we talked about. You get to flip a coin. Okay, if it's heads, you get $0, but if it's tails, you get $2 million. Okay, so here's the key. You have two choices, and we'll try to calculate the expected value of each of these games. Okay, so the expected value of the first game is just 1 million. Okay, you just get 1 million for sure. Okay, so that's the expected value. The second choice is also similar to the first question, game that we talked about. The probability of heads, assuming that it's a fair coin, is 50%, and the outcome, the value that you get if it's heads, is 50 or 0, and the probability that it's tails is 50%, and you get 2 million in that case. Okay, so the expected value is 50% times 0 plus 50% times 2 million. So the expected value is still 1 million, same as the first choice. But if you really had to choose, so assume that this is a real life choice, okay? What would you choose? Most people will go with the first choice. Say, I don't know, if you're like really wealthy, let's say you have like 5 billion in your account, then you don't really care about 1 million or 2 million, and you might want to flip a coin just for fun. But for most people, you're going to choose the first choice. You're not going to risk foregoing $1 million in the hopes that you'll get $2 million. Okay, that's just not a wise choice, right? For most people. So this is another example that illustrates the concept of risk aversion. Okay, so even though the expected values of the two choices are the same, they're equal, most people will prefer choice one because of the risk involved, the uncertainty or volatility involved with the choice, with the second choice. Okay. Again, the key is people, or to be precise, we'll say rational investors. Rational investors do not like risk. Okay. So people are risk averse. So all else equal, when these things are equal, people prefer an investment that's more certain compared to something that is more risky. Okay, risk aversion. Okay, yeah. So that's the first thing, fundamental assumption in finance. Okay, let's move on. So this slide I call the cycle of money between investors and corporations. Okay. So we're going to talk about corporations, what they are, why they're important, and so on right after this. But let's first talk about how they get money, where they get money from, and what the relationship is with the investors. Okay. So let's consider a setting. Let's say we have this corporation that's trying to make tumblers just for fun. Okay, tumblers, but they don't have any money. Okay, so the first thing they gotta do is they gotta obtain some funding, or they gotta get some capital, right? So we're gonna talk about two different ways that corporations can make or get money from investors in this course. And the first way is by issuing bonds. Okay, let's see, bonds. So yeah, when corporations issue bonds, they're basically borrowing money from investors. Issue bonds, meaning, so well, we have a separate chapter on bonds, so we'll get into details later. But for now, for the first exam, just know that when corporations issue bonds, corporations are borrowing money from investors. Okay, and investors that purchase these bonds are called bondholders. Okay, these bondholders are lending money to the firm. Okay, so they are lenders or creditors. Okay, yeah. Okay, so for this example, let's just say corporations issued bonds and investors bought $1,000 worth of bonds. $1,000. Okay, that money gets recorded on the right hand side of the balance sheet. Okay, so hopefully, well, I know that you guys took an accounting course, it's a prereq. So yeah, this $1,000 gets recorded on the liability side of the balance sheet. Okay. Okay. And suppose that this Tumbler corporation needs more money, and instead of issuing more bonds, the owners decide to issue stock. Okay, so when corporations issue stock, they're basically giving up ownership of the company, and in return, they're gonna get money. Okay, so giving up ownership. The existing owners are giving up partial ownership of their company. Okay, and investors who purchase these stocks, they become stockholders or shareholders. Okay, so we're going to talk about stocks later in another chapter on in exam 2, but when you purchase a stock, I'm sure a lot of people purchase stocks, college students, they do. When you purchase stocks, you're becoming a partial owner of the company. Okay, so they are becoming partial owners of the company. Okay, so bondholders and stockholders are fundamentally different. They're different classes of investors. They have different goals. Okay, so stockholders become partial owners, and let's say in this example, they issued $2,000 worth of stock, and investors put in $2,000. Okay, so this $2,000 now gets recorded under equity side of the balance sheet. Okay, so now the company raised $3,000 in capital. Okay, so that's why sometimes people call the right hand side of the balance sheet the sources of funds. So this amount, the total amount of $3,000 we got from investors, $1,000 in liability and $2,000 in equity. Okay, and using that money, the corporation's gonna now purchase assets that are necessary to do their operations. Okay, so assets will be worth a total of $3,000 in book value. So yeah, this could include machines that are needed for the tumbler production, factories maybe, or if they're making some deliveries, maybe they'll purchase trucks for the corporation. Whatever it is, the assets needed for the company's operations. Okay, so notice that this is just a review from your accounting. Assets equal liability plus equity, right? And the left-hand side is often called the uses of funds. So using the sources of funds, the $3,000 you got from bondholders and shareholders, the company is going to purchase assets, use those funds to purchase these assets to do its operations. Okay? So at this point, the business is underway, and hopefully the company makes a profit, and investors want to get paid. These bondholders and shareholders, they're not just some nice people giving money away just for fun. They need a return on their investment. Okay? And what do they get is bondholders will get what's called coupon payments. Coupon payments. These are interest payments, basically. Okay, so we'll talk about bonds later again, but just know that for the first exam, these big details. Bondholders are lenders, creditors, and they receive coupon payments, which are basically periodic interest payments. Okay, so corporations, they're obligated to pay these interest payments. If they fail to make these interest payments, the coupon payments, then the firm goes bankrupt. Okay, and bankruptcy is obviously no good, right? Shareholders, stockholders will get something else called dividends. Okay, dividends. So these are similar to coupon payments in concept, that it's periodic, and they're similar to interest payments, but the key difference is dividend payments. Dividend payments are not required. So when things go wrong, companies can stop paying dividends, and that's just fine. Okay, that's the deal. Okay, so for example, during COVID, the airlines industry took a big hit because no one was traveling, right? So during that time, airlines still had to pay their coupon payments to their bondholders because they were obligated to, but a lot of the airlines stopped paying dividends to the shareholders. Okay, so dividend policy changes all the time. Okay, and that's legal. Okay, yeah. Okay, yeah. So that's the cycle of money between investors and corporations. How corporations get money, and how the money flows back to investors, and this keeps cycling over and over. Okay. Okay. So we're going to talk about corporations mainly. Okay. So this slide just illustrates how there are many different forms, legal forms of businesses, and yeah, the reason why we focus on corporations is because most large firms in the US and across the world are in the form of corporations. Okay, and this slide illustrates the key differences compared to other forms of businesses with respect to things like taxation, liability, ownership, and so on. Okay. Okay. So for the exam, you just have to know that the characteristics of corporations. Okay. So let's first talk about taxation. Okay, taxation. Yeah. So if you look at the corporate income statement, going back to your accounting course, income statement, it looks something like this. First, you start with revenue, and then you have operating expenses like the cost of goods sold, SG&A, depreciation, and so on, right? And then you get to your operating income, or the EBIT, earnings before interest and tax. Okay, and then you'll deduct the interest expense. Then you'll get, I think it's sometimes called taxable income, or the EBT, earnings before tax. Okay, then you have your tax expense because you got to pay your taxes. This is the corporate tax. And then you have your net income. Net income. Oops. Net income. Okay. And so what I'm trying to show you is this thing called double taxation. Okay. So in the previous slide, we talked about how shareholders get dividends, right? So shareholders get their payment in the form of dividends. Okay. Dividends come from net income. Okay. If you took accounting, you might remember. Let's say the firm made $100 of net income. The firm's gonna then decide how much to pay out in dividends. Let's say they're gonna pay out $50 in dividends, and they're gonna retain the remaining $50 in the firm in the form of retained earnings. Okay, so from the $100 net income, the firm can decide to pay $50 out in dividends to shareholders and keep the remaining $50 in the firm in the form of retained earnings for future growth. Okay, so as a shareholder who are owners of these corporations, we just talked about how shareholders or stockholders are owners of the corporation, right? We'll get to this soon again. Okay, shareholders are the owners. As shareholders, you have to pay your, file your taxes at the end of the year, right? So you have to pay your personal, you have to file your personal tax, and your dividends, for your dividend income, you have to pay tax. Okay, so dividends are taxed. So the thing that I'm trying to show you here is this. Oops. Notice that at the firm level, this is the corporate income statement. Corporate income statement, you already incurred the tax expense here, right? Corporate tax. But then from that, you got your net income, and then you had your dividends. At the personal level, you have to pay taxes on your dividends again, right? So this is what we call double taxation. And no one likes being taxed twice, right? So that's one downside of being in a corporation. The owners of a corporation, they're taxed twice, okay? Whereas in these sole proprietorships or partnerships, I think you're only taxed at the personal level, and yeah, it's just different. Okay. Okay. Clear this. Okay. So that's taxation. Okay. And we're going to talk about liability on the next slide. Okay. Okay. So regarding ownership and control, it's also different for these forms. So for sole proprietorships or partnerships, I'll just give you an example of my barber in Kalamazoo. Okay, this guy, cool guy, has his own business entity. Okay, so this guy, his name is Chris, my barber. I think his business is in sole proprietorship. Okay, so the point here is Chris owns his barbershop, so the ownership belongs to Chris, and he controls the barbershop as well. Okay, he runs the day-to-day business. Okay, so whoever owns a firm is also running the business. Okay, so ownership and control are the same. Okay, and the same thing for partnerships. I think for partnerships, a lot of the what do you call them? Dentists are in the form of partnerships. You know, we have these dental offices with like 3 dentists. They form a partnership and run the businesses, run the business together. They own the business and they actually run the business themselves. Okay, so the ownership and control are the same. In corporations, the ownership and control are different. Okay, so as we talked about on the previous slide, there are many owners of a firm or of a corporation. As we talked about, anyone who purchased these stocks become partial owners, right? Meaning you and I could become an owner of any publicly traded company. You get a small stake, but you're still an owner, right? So here, let's say we have a bunch of owners. Let's do an example. Recently, SpaceX went public. Okay, Elon Musk's, I think it's a space exploration company, went public. Okay, so you could buy some shares of SpaceX and become an owner of SpaceX. Okay, let's say these are all, some few college students, and let's say this is me. We're all becoming owners of SpaceX, okay? But, I don't know anything about space exploration, so I'm not able to run the company, okay? The control belongs to someone else. I just have the ownership of the corporation, okay? So the control, we usually delegate the control to the managers, the CEO. Okay, so we'll talk about the structure very soon, but the control of the firm belongs to the managers, but the ownership belongs to the shareholders. Okay, so in management and economics, they call this the separation of ownership and control. Okay, so when we talked about the double taxation, we said it was clearly a disadvantage of being in a corporation, right? So if you think about the separation of ownership and control, think whether it's a good thing or a bad thing. Okay, so I'll give you like 10 seconds. Maybe you can pause. Yeah, it's important to think. So the separation of ownership and control is not really clear. Okay, one good thing is that it makes it a lot easier to raise capital. Raising capital is easy, okay? Because, people like you and me, even if we don't know anything about the business, as long as we have the money, we can provide capital to the firm, okay? So this is one of the reasons why most large firms are in the form of corporations. It's easier to attract capital, okay? So the separation of ownership and control is a good thing in this sense, but it is also bad in some aspects. And the main thing, which we'll talk about soon, is that the CEOs, who are supposed to do their best to maximize the wealth of the shareholders, sometimes deviate from what they're supposed to do. They're selfish people, so they waste the corporation's resources. They do like dumb things. Basically, they waste money. Okay, so they're not well behaved. So the separation of ownership and control could be good or could be bad. It's like a double-edged sword. Okay, yeah. Okay, but it's just a feature of a corporation. Okay. Now, let's talk about liability. We'll go to the next slide. But before we move on, note that when it comes to liability, all these other forms, for the owners, they have unlimited liability, whereas for owners of corporations, they have limited liability. And this is a great thing. Okay, so we'll talk about that right now. So the concept of limited liability comes from the fact that from the perspective of the law, the owners are not the same as the corporation itself. Okay, so from a legal perspective, the owners and the corporation, they're separate legal entities. Okay, and what this does is it provides an important protection for shareholders. And the key is this: shareholders are not liable for the corporation's debt obligations. Okay, so in the cycle of money slide, we talked about how when corporations fail to fulfill their debt obligations, That is, the obligation is to pay interest to the creditors. Okay, so I mentioned that when corporations fail to make the coupon payments, they'll go bankrupt, right? So when corporations fail to fulfill their debt obligations, they'll go bankrupt. Okay, and in a bankruptcy scenario, creditors can go after the wealth of the company, right? Yeah. So let's go back. In sole proprietorships or partnerships, when the firm goes bankrupt, the creditors can be like, you owners, the barber, Chris, sell your house to pay me back. Well, that was the deal. Sell your car. Basically, they can go after your personal wealth. Okay, that's why it's called unlimited liability for the owners. Okay, whereas in corporations, they can't do this to the owners. Okay, because the owners and the company, they're separate legal entities. Okay, so even though the corporation goes bankrupt, they need to sell their corporate assets, the machines. But you don't need to sell your house. Okay, so what it means is, as a shareholder, you cannot lose more than the initial investment amount. That is, if you put in $1,000 in SpaceX and the company goes bankrupt, the maximum that you can lose, max loss, is $1,000. Okay, so this is an important protection for shareholders, and again, this makes it easier to raise capital. Okay, so as an investor, you feel safe. Safe putting in your money. Obviously, you don't want to lose money. If you put in $1,000, losing $1,000 is not good, but still, it's better than losing your house and your car. Okay, so this feature, limited liability, is again offers great protection for shareholders, and it makes it easier for large firms to raise capital. Okay. Yeah, so these are the features of corporations. Okay.